business is all about making choices and decisions. What to invest or disinvest in, when to invest or disinvest, how and where to grow, which markets to target. And the reporting of these business decisions requires further choices related to valuation, measurement, and disclosure. Unless a manager is indifferent about the outcome, it'll matter what choice he or she makes, and then there will be incentives to make a given choice. Economic theory says that humans, in making choices, want to maximize their own utility. I think this is a pretty low-key statement. One may debate the extent to which they are successful at maximizing that utility, which depends on how rational people are in evaluating information and making decisions accordingly. But the fact that they would rather have a higher utility than a lower utility isn't that controversial. Especially if we think of utility as anything that the person finds useful or beneficial. Utility doesn't have to be measurable, especially not in financial terms. So incentives to achieve a certain goal, and thereby the maximum utility, are key to understanding managers' actions. In studying managerial incentives, a common point of departure is the theory of the firm, which describes a corporation as a nexus of contracts. A large corporation is nothing more than a collection of, or web of contracts. Contracts between employers and employees, managers and shareholders, the firm and suppliers. Because one individual cannot handle all tasks by him or herself, there's a delegation of tasks by one party to another. The boundary of the firm is defined by these contracts as well. And because of the separation of ownership from control that exists in such a contractual setting, there is information asymmetry between parties and conflicts of interest between managers and investors. Given that their interests may not be fully aligned, it's quite likely that the agent has incentives to not always act in the best interest of the shareholder. In this episode, we will discuss the most common solutions to this problem. How does accounting fit in? Well, it's a part of the solution. Information asymmetry leads to a particular type of incentive problem, the hidden action problem. That is, investors can't observe managers' actions, and this leads to potential moral hazard, where managers act in ways that are not in line with shareholders' best interest. They make decisions that, for example, result in managers enjoying free perks at the expense of shareholders, or that protect the manager from excessive risk, again at the expense of shareholders. If you only know one theory in accounting and finance, it might be agency theory, the theory that describes the problematic relationship between the principal, the party that delegates tasks, and the agent, the party who performs the tasks. Because of information asymmetry between these parties, the principal, or the investor in the context of firms, doesn't know whether the agent, or the manager in the context of firms, is acting in accordance with the wishes of the investor. Agency theory describes the need for efficient control mechanisms in order to monitor and discipline the agent. The first question that pops up is perhaps whether market forces couldn't act as efficient controls. An efficient capital market would efficiently inform the labor market and thus affect the decision to remove a manager who is misbehaving. In fact, studies empirically show that there is a correlation between CEO dismissals and, for example, return on assets, indicating that CEOs are punished or rewarded for the performance of the firm. However, a manager's concern about his or her reputation in the job market isn't believed to be enough. Market forces aren't enough. So additional controls are necessary, specifically various corporate governance mechanisms. One definition of corporate governance is that it's the system by which companies are directed and controlled. Or, another definition is the system of laws, regulations, institutions, markets, contracts, and corporate policies and procedures that direct and influence the actions of the top-level decision-makers in the corporation. The latter definition is very broad and actually includes market forces and the institutional environment. A narrower definition concentrates on internal features of the firm, such as the ownership structure, the boards of directors, and various contracts within the firm. Next, we'll briefly discuss the role of large owners in the board of directors in reducing the incentive problem, and then focus on optimal contracts, where accounting often plays a key role. The first best solution to the incentive problem is for principals to directly monitor agents. When the ownership is concentrated rather than dispersed, and there are few large owners rather than many small owners, there is less information asymmetry, and there is a greater chance that the owners can have a direct insight into what is happening in the firm. They will not only have the ability to observe what is going on, but large incentives to do so, since a lot is at stake for them. Large owners are controlling owners with a lot of potential influence. It's pretty obvious that the mix of and need for various governance mechanisms will depend heavily on the ownership structure. Moreover, large owners can ironically also cause new types of agency problems. One is known as the entrenchment problem. The large owners are so entrenched or mixed up in running of the business that they are no longer objective from the small holder's point of view. Just like the managers, they may have incentives that differ from other shareholders, and they have the power to affect and make decisions in their favor. While the monitoring incentive hypothesis states that monitoring by large owners is a successful solution to the incentive problem, the entrenchment hypothesis states that there is conflict of interest between large controlling shareholders and small or minority shareholders, which leads to the extraction of private benefits by large owners. Family owners are a type of potentially problematic active shareholder responsible for owner entrenchment. Overall, there appears to be more evidence pointing to the validity of the monitoring incentive hypothesis, however. While having a few large, controlling, and possibly active owners carry out the monitoring and management is common in small firms, it's not a feasible solution in large multinational corporations. This is where the board of directors comes in. The board of directors is what many people probably first think of when they hear the term corporate governance. It's the responsibility of the board of directors to monitor, discipline, hire, fire, reward, and assess management, as well as review the financial reports. In fact, they are both users and monitors of the financial reports. Given the impossibility of direct monitoring by small shareholders especially, the board of directors acts as an important intermediary and representative of such shareholders. The question is, what type of board is most effective at carrying out its monitoring task? Much research has been done on board composition, where two aspects in particular have been highlighted: board independence and board diversity. An independent board is one where directors are neither managers nor have close ties with management. Independence is believed to enhance the effectiveness of the board in that the directors will be more capable of monitoring and more likely to challenge managers' decisions. However, independence is not entirely beneficial. There is a risk that there will be greater information asymmetry between the directors and managers the more independent the board, and we all know the problems with information asymmetry. With respect to board diversity, this refers to such aspects as gender diversity, ethnic diversity, as well as diversity in roles, such as having employee representatives on the board. Having a mix between females and males is shown to improve board decision-making through improved risk assessments, while ethnic diversity is thought to improve the board's ability to understand a wider array of cultural and market-related aspects of the business. Diversity is all about bringing more variety in the type of knowledge possessed by directors. Now, even with monitoring by a board of directors in place, there is still likely to be information asymmetry between agents and principals. This is where contracting comes in, and the contracting role of accounting. Designing optimal contracts that align the interests of the agents and principals, the managers and the shareholders, is one solution to the incentive problem. One type of incentive contract is a compensation contract, which links managerial performance to pay. The manager's performance is measured in terms of firm performance, since this is what the shareholders is interested in. When the manager is paid based on the firm's performance, it stands to reason that the manager will want to boost firm performance. Using performance-based compensation contracts to align the interests of managers and shareholders, especially frequent in jurisdictions and firms where active or large owners are less common. That is, where there are many small shareholders and information asymmetry is likely to be greater. A good measure is a relevant measure. If the measure of firm performance does not reflect the manager's performance, it's hardly relevant. There are different types of measures one may consider, which can be divided into two main groups: accounting-based performance measures and market-based performance measures. We saw in the value relevance models that market-based measures of equity should be correlated with accounting-based measures of equity. but while they're associated, they're not the same thing. And one may capture more of some aspect of performance, while the other captures more of another aspect. If you look at accounting-based measures of performance, they are more conservative in capturing performance, which is a potential problem in a compensation context. Net income or pre-tax income, which are common measures in this context, only reflect realized income and expenses. The firm cannot record an income or revenue before all the performance obligations have been carried out, and expenses should be carefully matched to the revenue. This means that a strategic decision behind a certain business deal may have been carried out by a manager much earlier than the net income shows up. And if the performance evaluation is stretched out over many periods, it's not going to be well aligned with the actual efforts of the manager. The other problem with accounting-based measures is that accounting earnings can be manipulated by the manager. Everybody will have heard of earnings management. It's kind of ironic that you try to solve an incentive problem by designing contracts that give managers new incentives, and that is incentives to cook the books. By contrast, stock returns are not under the direct control or influence of the manager. And another strength is that stock returns reflect all of a firm's value creation to date. Unlike accounting, stock prices are not conservative. If a big research and development project has been initiated by an energetic manager, but it will take several years for it to bear fruit, the stock price will still reflect this. This is good from a compensation or contractual perspective. Basically, all firms with significant growth opportunities are more likely to have more relevant stock prices than they do earnings, at least in terms of how well they reflect managerial performance or effort. So why even have accounting-based performance measures then? Well, one has to remember that market-based or share-based measures also have weaknesses. The most serious weakness, which is often enough to dissuade boards of directors from using it, is that it's noisy. It may not necessarily reflect the manager's actions at all, but just market-wide trends. Moreover, stock prices are comparatively volatile. Managers who have a large portion of their wealth in the firm's stock might not have a fully diversified market portfolio, which increases their risk exposure. This might make them avoid taking any risks that would further increase the volatility of the firm's stock. That is, it makes them too risk-averse for other shareholders' taste. Alternatively, if stock options are used as the market measure, there is plenty of incentives for managers to try to manipulate the share price and make it more volatile. Because of the way options work, they're potentially focused on short-term changes in the share price. To sum up, due to the separation of ownership from control in a firm, and that the interests of shareholders and managers are not necessarily aligned, there exists an incentive problem. The big question we keep coming back to is whether accounting is successful at reducing information asymmetries, and more specifically, where incentives are concerned, whether moral hazard and the hidden action problem can be mitigated with accounting information, either indirectly informing investors and boards about the manager's actions, or by serving as input in contracts that serve to align the interests of shareholders and managers. What we're referring to in this discussion is the contracting role or the stewardship role of accounting. It is arguably stronger or weaker in different settings, and the question of whether, for example, IFRS is useful in a contractual setting has been the subject of much research.